Okay, folks, welcome back. Long wait between Model 2 and 3, I know. Before I get into it, the reason why it's taken me this long is I'm wrestled with the idea of how I can make these models as helpful as possible, but also avoid the goobers out there that are really just trying to teach what I'm giving away here. It's been very difficult. So the concepts and models that I'm going to be providing, starting with this one here, 3 all the way up to the 12th one, will be in this format. It's going to be relying heavily on your understanding of what you've already learned in the mentorship. I'm not rehashing everything. I'm not spelling it out to the last letter. Originally, I wanted to do that, but just look around on Twitter and on social media and YouTube. You can see there's a lot of folks now in the business of teaching my stuff. So whether they're using it under the guise of the free content or worse, what's coming from the mentorship. I got 6 new people I got to start tracking, and it's just become disheartening, actually, because I knew this was going to happen. I mean, everybody knew it was going to happen, but I'm not going to provide a PDF and a video where they can just mimic that and be business teaching one model or more than that. So this model will be teaching the swing trading ICT approach, or one method of doing so. And its primary focus is going to be attacking daily liquidity pools. Okay, so that's going to be the draw that we're using for this model. And as you'll see with the remainder of the models that's going to be shared, we're focusing again on one specific criteria as our justification, if you will, for looking for a setup. And then we're going to look for the actual ingredients that go behind the scenes that make that setup viable. Okay, so let's continue on. Okay, so we're looking at the swing trading model. Again, the draw on liquidity, what we're anticipating in terms of why the price should be moving in a direction one-sided, higher or lower. It's going to be based on daily liquidity pools. Okay, but the stage is going to be set for that whole business, okay, because there's going to be liquidity pools always in the chart. But the underlying condition that sets up the setup is the stage, okay, and that stage is going to be the COT hedging program. Okay, so we're looking at the last 12 months of Commitment of Traders report data on just the commercial traders only, getting its highest high and its lowest low in terms of their net position, dividing that range in half. If it's above the midpoint of it, we're going to be looking at that as a bullish commercial buy program, and or if it's below that midpoint of that last 12-month range, we will be assuming that it is a commercial sell model. Okay, if we have that stage and we have a daily liquidity pool on the daily chart, okay, we're going to be looking at that as our setup, and our entry pattern to trade this model is going to be the optimal trade entry. Okay, so now this is what I'm ringing in now, because this, for the lack of better terms here, it's going to accomplish the method. But if I shared this for instance, on Twitter. I'm confident this would not mean very much to the lay audience. Now, for a person that's gone through all 12 months of the mentorships and studied the content, if you look at this as I explain it, you'll know exactly where to go into the mentorship content and dig up more information on how those specific components are amplified by using this whole concept. Now, this is a conceptual idea shown in graphic form. So in other words, this is the entire model shown in picture form. Okay, so when you think of this trading model, this is how I interpret it. Okay, this is how I internalize it. This is how I see it in my head, and how I go into the price action to hunt the setups itself. Okay, so along the top, you can see it's the COT hedge program, and I'm giving you a graphic depiction of 12 months. So in other words, if today we were looking at a particular market, and this is what we would see, the highest high and the lowest low of the range. If it has broken the previous low in the last 12 months, then obviously we extend the range to the lowest point that has most recently been created. So that would be seen in this example here. So I'm throwing that in as an actual bonus, because I didn't mention it too much during the mentorship because people were coming and going, and I didn't want to give a lot of the information out for people just going to hang around for 1 or 2 months, in the latter stages and then leave. So when we have our COT hedge program, okay, so we've modified the COT net trader position chart as taught in the mentorship. If it's showing that the commercials are bearish relative to that concept, and the daily chart shows a liquidity pool, in other words, equal lows or a ideal low that would have a lot of sell stop liquidity below it. If that criteria is there, we would hunt optimal trade entries to go short, targeting a run on those sell stops. Now the focus is we're going to be anticipating the monthly chart or the monthly range to provide us the swing model. Okay, so the time frame we're using to facilitate the trade is on a monthly chart. So the candle that's being depicted here, we're anticipating the down movement of a monthly candle. While this candle shows it closing near the low, we do not require it to close down there. We just want the range to expand down. Also notice that at the end and a new beginning of a new month, we're using the IPDA data ranges. A lot of flack has been said about this, and it's just simply a measure of going back the last 20 days, the last 40 days, or last 60 days. In other words, the price action in the last 3 months for a quarterly effect. Looking back at either one of those intervals, if we see a liquidity pool, that's the one we're going to be targeting if this criteria with the COT hedge program is in effect. Okay, so let's move on. Obviously, everything can be reversed. Here, this is the concept in graphic form, just reversed. If the COT hedge program is showing in the last 12 months commercials are a net buyer, and the price action on a daily chart shows a equal high or a very clear intermediate term high where buy stops will be resting for a liquidity pool, we will be targeting that, and we'll be looking back 20 to 40 to 60 days from the new month start, and we'll be framing that as our context for the trade. But again, the time frame we're focusing on is we're looking for the monthly candle to expand higher in this condition here. Obviously, you can see when the COT data for the commercials, if it's showing them as a net buyer, then the criteria is enforced with the daily chart showing a liquidity pool resting above equal highs or an ideal intermediate term high. We will be looking for that as our draw on liquidity. Again, we do not require the monthly candle to close near its high. We just want the range to expand to allow us an opportunity to find a setup to be profitable. Okay, and again, this is the monthly range. We're going to be looking for the market to expand up on bullish months to a buy stop liquidity pool and or run equal highs on the daily chart. And for the monthly range when bearish, we're going to be looking for a run to equal low on the daily chart and the sell stop liquidity pool resting below an old low. Okay, so this is what we have here. Our example for this model is going to be on the Canadian dollar. You'll remember this actually because we covered it during public analysis. Really, I did it all on Twitter, and everything's been shared there. You can still go back and look at it. We really tracked this one online publicly. So again, this is Canadian dollar. So when we're looking at the Forex market, everything has to be reversed because the pair that's associated for Canadian dollar that we trade against the dollar is dollar CAD. So everything we see in the futures contract, which is being shown here, has to be reversed because it's an inverse relationship when it's in the Forex pair dollar CAD. Okay, the arrow is just depicting the point at which we're focusing on for the setup. And I'm giving you the red line here highlighted to give us the entire total range of the last 12 months at the time of that arrow. Okay, so you can see we're below the midpoint. So commercials are in a net short position relative to the 12-month range. So we would be looking for a liquidity pool in the form of equal lows on the Canadian dollar futures contract or equal highs for the dollar CAD pair. Okay, so the logic behind this is the monthly range when it's bullish will likely see a strong impulsive move higher, and inside that monthly range or candle there are typically 4 weekly ranges or candles. We're going to be seeking the range inside the monthly range before the candle completes and a new monthly range begins. That is to say, we want one or more of the 4 weeks that construct a monthly range to profit. Okay, you can see the chart here. That little tiny candle in here that's being delineated with the arrows, that's all this setup is focusing on for this particular example here. Now, obviously, everyone wants to see the big move off the monthly chart, and that's an entirely different type of setup. I'm giving you a model here. You don't need the biggest moves, okay? And you'll see that this is actually very sufficient. Zooming in on a weekly chart, this is the entire move that will be captured with this model in hindsight as an example, but again, everything has been mentioned in Twitter. And on the daily chart, this is a move that it shows relative to the pattern and model that we're teaching here. And we're going to expand this a little bit bigger. What we're looking at is that move there. Now you're probably saying, well, why couldn't this just be a short-term trade, or why can't it just be a one-shot, one-kill? It can, and like I said in the mentorship, a lot of the setups can at times overlap. But we don't know if it's going to continue higher or lower when we're taking the trade. So we're just framing the idea here to give us the context to work within in terms of a consistent model. Okay, you can see here the IPTA data range, new month starting here, March 1st, 2018. We're looking back 60 days. IPTA data look back takes us back right to those equal highs. And then we have a 20-day cast forward. So we're anticipating a potential move to complete and or a new setup to start 20 days after the beginning of the trading month at March 1st. You can see the equal highs, which is a buy stop liquidity pool. Now price had already ran initially there and started to sell off, but we're looking at it as a potential continuation and anticipating it to wipe out a little bit more of that liquidity, go a little bit deeper into that. So this is going to be our optimal trade entry. Now notice I'm showing here March 1st. And now think of it like we teach the intraday patterns where we have a Judas swing. There is a kind of like a pseudo Judas swing here on the monthly. Okay, if you look at opening price on March 1st, price comes back down after initially rallying. We don't want to see that. We're focusing on movements at the open at the beginning of the month or below it. Okay, so when price trades down below that opening price, I already know what the question is going to be is what's the opening price. As soon as we start a new month at the beginning of the Asian session, first trading day of the month, that's the opening price. Okay, we'll use that one. And if you want to get fancy, you can use the opening price at midnight on the first trading day of the new month. I use both of those, and I'll refer to it as the first week of trading transpires. But price, after making an initial rally higher, trades down into the optimal trade entry, providing an opportunity to buy. And also notice it takes out an initial swing low that you can see right at the 70.5 level, or the OTE level on the fib. It trades just below that a little bit, and then that's the buy. Okay, that's the pattern, that's the setup you're looking for. Now this is a 4-hour chart. You don't need to go anything lower than that, but I'm going to show you how you can fine tune it if you want to get a tighter stop than this. Obviously, you know what your stop loss is going to have to be by using the mentorship and using optimal trade entry and all the stop loss placement things. I'm not going to include all that here because to do that, I'm basically giving you an entire mentorship in one video, and I'm not doing that for people that are sharing information now. I'm not making it easy for them, let's put it that way. But if you studied, you know the things, mentorship, or you know where to find them because of the topic titles, obviously it makes it a lot easier. Now you're probably asking yourself, why am I using that anchor point for the fib? Well, we're going to drop down into the hourly chart and you'll see why. You can clearly see that's a swing low. All I did was use the transition from a 4-hour down to an hourly chart, and you can see that fib is overlaid here. And you can see a very clear swing down into the optimal trade entry, and now we're including the hourly because it's going to be day of week. So if we're buying, okay, and we're swing trading, we want to be doing what? Trying to buy on a Monday, Tuesday, or Wednesday. If we're selling short and we're bearish, what are we going to be doing? Looking to sell short on Monday, Tuesday, or Wednesday. Okay, and the kill zones are a London Open and or New York Open primarily. Okay, so now what if you want to reduce the amount of risk? You don't want to take that entry at the optimal trade entry and have to use a stop loss, down at below the 127.40 level. That's a pretty big big stop loss. In some day traders' minds, or certainly a scalper, they would think that's incredibly too large. I can't do that. If you take the optimal trade entry that is here from the afternoon low on that Monday and expand it up into the initial high of the day on Tuesday, right before they had the big move up and rally, you'll see that as another optimal trade entry there. And you can use a stop loss just below the afternoon low on Monday of that particular week. So now you can reduce the amount of risk and still be able to take this as a swing trade. Okay, so you can get a much larger R multiple for this particular setup. Now notice that also on the hourly chart, you can see that there is a liquidity pool with the previous week, March 5th, 6th, and 7th. We have equal highs there. That's what we're targeting. That's a daily liquidity pool. And it's also an overlap of the two fibs. Notice what happens here. We see that target one line on the initial fib on the larger price swing and another fib level from the shorter price swing. Now you're probably asking, what's all those extra lines up there? Okay, I want you to write this down in your notepad. Okay, I'm not providing it on the screen because I don't want people just having access to a PDF. If you're going to steal my stuff and you're going to share it, you're going to have to work for it too. So the levels I have on here for the fib is negative 27, negative 68, negative 127, negative 168, 2 even, okay, 2.0, and then 2.27. These are all negative numbers, and then negative 268, negative 3, negative 3 decimal point 27, negative 3 decimal point 68, negative 4.0, negative 4.27, negative 4.68, and negative 5.0. Okay, and you'll get these lines on your dollar CAD chart. and notice that there's a connection or overlapping of those two levels there. That would be your target. Now you do not get that last little piece movement up, but it's not necessary. Okay, and you can see what happened immediately after that. It really falls out of bed and comes back down to the original optimal trade entry. Now, your risk on trade is completely up to you, and that's how I'm going to be teaching the rest of these concepts, because we talked about risk management, we talked about leverage in the mentorship, we know where the stop should be, and now looking at target 2, since it's a swing trade, okay, on the second bid, that target 2 would be your first scaling. So if you're going to take something out, you would take something there, and then you would do it at every full incremental number. In other words, you would take some at like 2.0, negative 2.0 on the fib, negative 3.0 on the fib, negative 4.0 on the fib. Or if you want to go a little bit more and try to get a little bit more juice out of the lemon, you can use the 3.27. These are all, again, negative numbers. The reason why it's a negative number is because as the fib goes higher, notice the lowest number is 100. So as we go higher, they're dropping in number. So once we get to that top line, it's the 0 line on fib. So anything higher than that has to be a negative number. So you can do like negative 2.27, and then if it goes to negative 3.27, you can take something off there. All of that's customizable. You can do all those types of things yourself, but personally, you don't want to just take it at the fib level. You want to take them off when there's an old high. Okay, the first target 2 on the second fib, that's just a take something off to reward yourself. That cookie reward to make the trader feel good. So that way, if the trade does fizzle out, at least you took something off of it and got it on the flesh. But notice how if you start looking at all the fibs that start to expand past that second Fibonacci level of target 2, start looking at those price swings to the left right before we get to those equal highs at the buy stops. If there's a fib that overlaps with a run above those short-term highs, as you can see right here at this one, okay, above this high, we have this fib. So we take that as an area of scaling, take something off, and obviously take something off that gets right here, right at that level, and then look for the combination of the two fibs blend together, and you would have a really handsome setup, and also an overlapping of institutional level 130.80 right in here. So that's going to be this one for price action model number 3. Everything is reversed for short selling. Study it. Everything's in the mentorship. I did not teach anything new here except for just an expansion on the fib. And again, all the levels are in negative, so it's a negative or dash or hyphen, and then enter the numbers. Okay. And I'll give you an opportunity to ask questions in the forum. You guys can ask questions specifically in there, and I'll answer all those that you have for this model. And until next time, I wish you good luck and good trading.